Welcome, everybody, to Stories of the Market, our very first inaugural episode. We're very excited to be sharing with you illuminating stories from the market. We use a book called The Matrix Book, which has all these numbers in it, which to the average person wouldn't tell any stories at all. But we bring stories right out of those numbers. And, before COVID, we would be in person all the time, in front of people all the time, showing them this book because it just shows what really happens in the market and cuts through all the hot air out there that you hear about what happens in the market. We call it market storytelling. So with COVID in place, it's a great time to put this awesome storytelling resource to video. So enjoy. This is what the front of the Matrix book looks like. It's a big book. And let's start with the S&P 500. And the S&P 500 is a proxy or a representation for U.S. large stocks. Now, we talk about the Dow Jones Industrial Index all the time. It's only 32 stocks. Most people don't know that. It's really of little use, in my opinion, because it's so few stocks. It doesn't always represent what's really going on with U.S. large cap. And I would even argue that the S&P 500 is not ideal because it doesn't have all the companies in there. It has 500 out of about maybe 600. And the people that run the S&P 500 arbitrarily decide, which ones they're omitting from the 500. So it's definitely not perfect, but it's pretty darn good, and it's definitely been well marketed. And here's all the tiny numbers we have on the S&P 500 and the Matrix book. Oh gosh, how are we going to possibly look at that? Well, what we're going to do, we're going to zoom in on the upper left. We're going to zoom in on the bottom left. We're going to zoom in on the diagonal, and we're going to zoom in on the bottom right. So starting with the top left, I'm going to show you how you read this chart. So this box allows you to read over a time period. So the top number here, it's the beginning of the year 1926, and down here on the side, 1937, that's the end of 1937. So if I go down to the bottom of the box here, that 3.6 number, that's the annualized return across the time period of January 1, 1926, down to 12/31, 1937. So that's how you read this chart. It's kind of like those old-fashioned charts that we had. Well, maybe you don't remember, but I do, where you could say, well, here's Omaha, here's Cleveland, and here's how many miles it is from Omaha to Cleveland. And up here at the top, by the way, so this first number, that would be from the beginning of 1926 to the end of 1926. So 11.6 here at the top represents the return for 1 year, the calendar year 1926. So with that, let's look at the bottom left. We just looked at the top left. Down here at the bottom left, directly below at the bottom of the page where we were looking before. And what this does is represents the most data we have. So the years that are at the top are reprinted down here at the bottom. So this number 10.2 is from the beginning of 1926 to the end of 2019, which I think is about like 94 years or something like that. And that's the most data we have. And the annualized return over that large time period, 10.2% return. Depending on what particular time period you look at, roughly 10%, let's say. You can see as we go across from left to right here, each one of these numbers, as you go left to right, has one less year of data, but they're still all have a lot of data. And so you can see the S&P 500's returning anywhere from about 9.5% to about 11.5%. But we'll just use 10% as kind of a rough number for the expected return of the S&P 500. Okay, so now let's take a look at the diagonal, and the diagonal are 1 year returns, because if we had the numbers on the side here, this number here would be 1964 on the left-hand side, and this 16.5%, that's the 1964 calendar year return. The number 12.5% here is the 1965 calendar year return. And as we look down the diagonal, what you'll notice is that we don't see the annualized return of about 10%. They're all different. They're way above 10%, way below. But we do have this one here, 11.1% for the calendar year 1968. But what this tells us is that the numbers bump around all over the place. They're not too consistent, are they? There's a lot of variability. There's a lot of statistical noise in the year-to-year values, S&P 500. So you can't count on any 1 year being 10%. But over the long haul, we expect around a 10% return for the S&P 500. Now, let's take a look at what happened last year. We look here at the bottom right-hand corner of the chart, which we said we were going to look at. That's the calendar year 2019. and the return was 31.5% for that year. So the last full year, I'm talking to you here in 2020 right now, 31.5% for the calendar year 2019. Now let's talk about a special time period that people talk about a lot because it was such an unusual time. There were some difficult times. There was a dot-com crash in the beginning of it, and there was the 2008, 2009 Great Recession towards the end of it. But as we look at the lost decade from 1/1/2000 to 12/31/2009, we see that the return of the S&P 500 was negative 0.9%. Well, a lot of people think of the S&P 500 as being kind of the market, and so they just assume everything was bad during that time frame. But as we'll see, that's not true. But definitely the S&P 500 did have a 10-year time period that was bad, and a lot of people said, oh my gosh, that's never happened before, and the world's coming to an end. But in reality, it has happened before. And in fact, there's been an even worse time. So if we look at the period of 1929 to the end of 1942, negative 1% annualized return over a 14-year period. So multiply negative 1 times 14, we have a negative 14% cumulative return over that 14-year time period. So there have been worse times, and it can go bad and have a negative return, let's call it, for as long as 14 years. So what did we learn in today's first session? Well, we learned how to read the Matrix book. We saw the S&P 500 expected return is around 10%, and that there's a lot of variance in those numbers. They bounce all over the place, hardly ever actually hit the number 10%. And they can be negative for more than 10 years. In fact, we saw one time period of 14 years. There's a good return last year, calendar year 2019, but this is just one asset class. This is large U.S. stocks. So stay tuned for more market stories. Look forward to bringing them to you. Number 2 is coming up soon, and have a wonderful day. Bye-bye.